Welcome back friends to the class 26. In the previous two videos we have studied the sample valuation and legal reports. I hope you have liked those videos. And now we are moving ahead on more technical parts of the financial decisions done by the lenders. We have understood clearly about the property angle. Now I have already told you in few videos back what are the critical factors that impact the loan decision of the bank. These critical factors include the collateral type and value and quality and everything else that I have discussed in previous 7 to 8 videos with you. That portion is already covered by me in full details with you. The second part that impacts the loan decision, the loan amount decision, the loan final loan decision, whether they are going ahead with the loan or not, it is the financial eligibility. The borrower should comply with the collateral eligibility as well as he should comply with the financial eligibility. So suppose if the collateral value of the borrower is 100 rupees, property value is 100 rupees, and the bank can give a maximum 70 rupees loan on that, 70 rupees on the loan on that, then if supposedly the collateral is clear in all technical and legal aspects, then 70 rupees is the maximum loan amount basis the security, right? Now comes the financial eligibility part. The mere 70 rupees does not entitle the borrower to take 70 rupees loan from the bank. He has to justify this 70 rupees loan from his financials, from his income as well. Suppose his financials state that the client is eligible for maximum 50 rupees worth of loan, then what will be the final loan amount that will be offered by the bank to the client? That the final loan amount will not exceed 50 rupees in the case. If suppose the financial eligibility of the client comes to 80 rupees, then what will be the final loan amount? The loan amount will be 70 rupees. Final loan amount will be 70 rupees. So whatever the loan eligibility comes from the collateral analysis, whatever the loan eligibility comes from the financial analysis, the lower of both is considered as the final loan amount of the borrower. So here, if we take this case, 70 rupees is the maximum loan amount. Remember the word maximum loan amount that bank can offer to the borrower. But this does not mean that banker will give 70 rupees loan to the client. This does not mean that client is now entitled to take 70 rupees from the bank. This amount can further reduce. Remember that if we study all these factors, even if all of them are positive, they cannot increase the loan amount beyond 70 rupees. They can only contribute to fix this loan amount of rupees 70 to the client, or further reduce it based on the various risks involved. Suppose if the financial analysis is a bit weak, the conduct in civils and banking is not too much good, the business and the industry in which the client operates is a medium risk industry. Internal policy of the bank states that we cannot fund to this industry. Market feedback is average, net worth is average. Then the bank may get further reluctant to give 70 rupees loan to the client. The bank may say there are way too many risks involved. They can even reject the loan if these risks are too much to handle to the bank. And if they decide to go on, then basis the risk study, the bank can reduce the loan amount from 70 rupees, right? So the collateral value and the financial eligibility gives the maximum loan amount that the client can get from the bank, and these factors can either confirm this loan amount, or they can contribute to reduce these loan amounts from the final eligibility of the borrower, right? So now we will discuss in coming videos the financial eligibility part of the borrower. Now, if we study the financial eligibility of the loan, there are many factors that impact the financial eligibility of the loan. I have classified them in two different parts. One is the product specific norms that impact the financial eligibility. The second one is the internal bank guidelines that can affect the financial eligibility of the borrower. So let's study one by one. I am giving a just briefer here. We will explain the details in later parts. First, we come with the product specific. There are two types of products usually run by the banks. One are the term loans, the EMI based loans in which you pay the monthly EMIs, and the second one is the working capital loans. Working capital loans like which are given to you to cover your day-to-day expenses. I have already explained the whole working capital concepts in the first 5 to 6 classes, right? So these term loans that are EMI based, that have fixed control on the cash flow of your business. So assessment, the financial eligibility of these loans are based on the income of the borrower. Since the repayment of these loans by way of EMI is done from your bank account in cash, in bank account every month, so you must have the liquid income enough, liquid monthly income enough generated to repay these monthly obligations. So the assessments of these term loans are purely based on your monthly actual in hand income. Whether you are a businessman, you are a salaried person, or doing anything, any work, your monthly in hand income from concrete resources, from the resources which can be documented, which have a backing, proper backing of papers and physical site visits. These income should justify your monthly obligation. Only then you will be eligible for the term loan exposure. Now I have given the some examples of term loans, like machinery term loan. You are taking term loan to buy the machinery. The eligibility will be based on your monthly income. Building term loan, working capital term loan, we can say the general purpose term loan, loan against property, again a general purpose term loan, unsecured business loans, housing loans, auto loans, commercial vehicles, commercial equipment loans. All of these loans are we can also mention DOD limits, drop line overdraft limits here as well, right? If done by lab department. So all of these loans are based on your monthly income, since there is fixed obligations involved in all of these loans, right? The second type of loans are working capital loans. Working capital loans examples are cash credit limit, overdraft limit, packing credit limit, we call it pre-shipment and post-shipment finance, letter of credit, buyer's credit, bank guarantee, supply chain finance. Supply chain finance includes factoring limit, warehousing receipt finance, reverse factoring, bill discounting limits, channel finance. There are multiple products involved in supply chain finance independently as well. So all of these are working capital loans to manage your day-to-day expenses. Friends, I will be discussing all of these products with you in detail except for auto loans, CV loans and housing loans, because I don't have any experience in these products. Rest all of these loan products will be discussed in detail by me with you practically, which I have done in my banks. So assessment of these loans are based on your investments part. These loans are assessed based on your monthly income, which is retrieved from your profit and loss account majorly. These loans are assessed basis the MPBF, maximum permissible bank finance, which we usually calculate from your balance sheets. So these are asset driven, investment driven products. These are income driven products, right? So there are multiple methods of MPBF here. The one is turnover method. We will discuss in full detail. Working capital gap method, cash budget method, and the second working capital gap method, we call it method 2, right? So these MPBF methods are used to assess all of these working capital loans, right? All of these these norms, the turnover method, working capital gap method, cash budget method, in some of the products they are restricted to the drawing power of the borrower and operating cycle of the business. If the drawing power and operating cycle of the business are not enough to justify the requirement, then even if client has higher eligibility on these methods, still bank will give the lower loan to the client, right? So don't worry about it. I will also discuss the drawing power concept, the operating cycle concept I have already discussed with you. Drawing power concept I will cover in full detail. This is just a snapshot kind of video where I am telling you what is coming to you in coming days, weeks, or months. Some of these products like letter of credit, buyer's credit, packing credit, besides these MPBF, they have their individual assessment norms as well. LC, buyer's credit, packing credit, bank guarantee, supply chain, they have their own individual specific assessment norms as well. Besides these, right? We will also cover all of these eligibility calculators in full details with you in coming weeks or months, right? So this is the part where the eligibility is based on the product. So suppose the client is based, so basis the financial eligibility, client is eligible for certain amount of loan. So you are ready that client is financially eligible, the financial supports, the monthly income supports this much of a loan. So I should give this much of a loan to the client. But give it a second thought. Read the internal bank guidelines as well. Before finalizing, read the internal bank guidelines as well. Your client may be financially eligible based on income, based on his balance sheet, but your bank policy, if states that the industry in which the client is operating, we will not take more than 5 crore exposure per borrower in this industry. If your bank internal policy states that they will not take more than 5 crore exposure per borrower working in this industry, then even if your eligibility basis MPBF or basis income comes to 8 crore, 10 crore rupees, you will not be able to give more than 5 crore rupees loan to the client. Location specific thing can be here as well in banks. In some of the locations where there may be a community dominant area, or there may be some riots, or there may be some floods, or any kind of risk involved, maybe some border areas with tensions with the neighbor countries. So the bank may incorporate location wise norms as well, right? Bank may say that this specific location we will not give more than 50 lakh rupees loan to one single borrower. These location specific norms can be based on bank's portfolio analysis as well. Bank may analyze its portfolio and say that in this particular location we have highest delinquencies, so we will not give more than 50 lakh rupees loan per borrower in this location. So the location specific internal bank guidelines can be there as well. There can be guidelines based on the different departments as well. Some of the departments may have maximum loan restriction that they cannot give more than this particular amount of loan to a one client or the another. Some of the departments like ECG or the corporate department, they have more liberal approach in assessing the clients, right? So they are more open minded, so they give large ticket size loans to the clients, so they may be more open to accept the client based on the MPBF or the incomes. Their calculators may be some more liberal than the others, right? So these are the factors that can impact the financial eligibility of the borrower that I have discussed. One by one, I will cover each of these concept in full details with you, right? So stay tuned and share this channel to everyone. I hope you have enjoyed the video. Thank you very much.